How's it going, everyone? I know it's been around a month since I uploaded last, and for any of you who watch my videos regularly and actually enjoy them, I'd just like to apologize. As you can see, I hurt my wrist around 3.5 to 4 weeks ago, and I haven't been able to do any exercise since. No lifting whatsoever. I've just been playing like soccer, I'd say like once a week, but that's not enough physical exercise for me. So I really haven't been in the best headspace, and I'd like to say that's why I haven't uploaded, but I really don't want to sit here and make any excuses. Now, talking about my personal problems during these last 3 weeks might be for another video, but in today's video, I want to talk about option trading. Now, some of you might have heard the term option trading, but you might not really know what it is. So today I want to give you like a quick rundown of what drives these 1000% gains in the stock market. So what is an option contract? An option contract is an agreement between a buyer and a seller that gives the buyer of the contract the right but not the obligation to buy or sell the specific asset at a specified strike price before the expiration date of the contract. So there were a lot of terms in that might surprise you, like strike price, expiration date, and like what even is the asset. Well, in this case, the asset is the underlying stock that you're trading the option contract on. And I'll also walk through a live example later in the video so you get a clearer understanding of what exactly is going on. So what is the expiry date? The expiry date is a preset date on the contract, and on this date, one of three things will happen. Your contract will either be worth $0, or you'll either have the obligation to sell or buy the underlying asset, or you can sell the contract itself to another buyer so that they can either buy or sell the asset. Now that might sound confusing, but it'll all become clear with these examples. So the strike price is a preset price in the contract at which the underlying asset can either be bought or sold if it is exercised. Now there are also two main types of options that we're going to be talking about, the call option and the put option. The call option gives the buyer of that option the right but not the obligation to buy the underlying asset at the specified strike price, while the put option gives the buyer the right but not the obligation to sell the underlying asset at a pre-specified strike price. Also, it is important to note that on a platform like Robinhood, where I'm going to walk through the example, each contract gives the buyer the obligation to either buy or sell 100 shares of the underlying asset. So when would you buy a call option and when would you buy a put option? If you think the value of a stock is going to go up within the next few months or weeks, you would buy a call option. But if you think the price of the stock is going to fall, that's when you would buy a put option. But enough of this jibber jabber. Let's shift over to Robinhood, because I definitely think it'll be easier to understand if you see a live example. So as you can see here, today we're going to be talking about the AMD stock. Now just today, AMD is over 4.6% in the day, which is quite a bit considering it's such a big company. But just remember that option contracts take into account the price change until the end of the day. So these after hour numbers, they don't count. So all you got to do in Robinhood is go to trade AMD options, and you'll be able to see buy, sell, call, put. So we're going to be talking about selling options probably in another video, because that's a little more complicated. But for today, just the basics is so let's see, buy a call option. So under this drop down, these are the expiry dates. So you can basically select when you want your option to expire, and they usually go week by week for closer dates. But as you can see, as we get further off, we either have monthly or like basically monthly options, as you can see. As you saw before, the price of AMD moved only 4.6% today. But if you were to scroll down to a strike price of $165, which is right there, you can see that the percent change of this option price was 100%. That means at market open today, if you had bought this very option, 165 strike price AMD call, expiring on December 3rd, you would have made 100% gains throughout the day, which is way more than the 4% that the stock price changed by. So there are quite a few things to make note of here. So first, let's go over this price. So this price of $2.59 is what you would pay for a call option of the strike of $165 expiring on December the 3rd. It's also important to keep note that you would not be buying this contract for $2.59, but you would be paying $259. This is because you have the obligation to buy 100 shares of each of the underlying asset with each contract. So that means you multiply 2.59 by 100, which gives you 259, which would in this case be the price of the call option. As the share price right now is 163.25, we call any strike price above this price for a call option out of the money, and any strike price below this price right now in the money. What that basically means that is that if on December 3rd, which is Friday basically, the share price of AMD is 163.25, that means this 165 strike price contract will expire out of the money. That means the value of this contract will go to zero on that day, no matter how close it is or whatever. Even if it's 149.99, this value of this contract will be zero. And as long as you're in the money, so even if the share price expired at 162.51, you'd still be slightly in the money, so you'd still have the ability to exercise your option contract and buy the underlying shares if you want. Now let's look at the same for the put option. So as you can see, if for put options, this 165 strike price is in the money. So if the share price on December 3rd is anywhere lower than 165, then this option will have the obligation to be exercised, but you don't have to, while this option of 162.5 will expire worthless and zero. And also it's important to note that as you can see, as the price of AMD went up today, the put options lost value, as you can see in red, while the call options gained value. Other than that, okay, let's walk through an example of what would happen if you were to buy let's say this $165 strike price option today. So let's say at market open, it's still $2.59. So that means you would pay a premium of $259. Now, as I said, there's three things that could happen. So let's just say you bought this $165 strike price call option for 2.59. So let's just talk in terms of singular shares here. So your break-even point for this would be 165 plus 2.59, which is 167.59. So let's say on the 3rd of December that the AMD stock price is 167.59. That means that you have the right but not the obligation to exercise your contract and buy 100 shares of AMD at $165, which is the strike price. So your total cost would be 165 into 100 plus 2.59 into 100, if you're talking in terms of hundreds of shares here. So that would be equal to 16759 as your total cost. But now you also have 100 shares of AMD at the price it is at now, which is 167.59. So you broke even at this price. The reason why a lot of people consider option trading extremely risky is because if you were to buy this $165 strike price for December 3rd and the option contract and the price of AMD on Friday was below 165, you would lose this entire $259. The entire premium for the option would just be gone and you can't make that money back. Well, another way to make profit on these contracts is by just simply selling the contracts. Well, we can't calculate the exact price change that would occur, as there's a pretty complicated formula to calculate option premium. We can say that, let's say you bought this at $259 and tomorrow AMD went to a share price of $166. This contract would still be in the money and would have a value of, I'd say, around roughly $500. So at that time, you could sell this contract to another buyer at $500 and make a profit of 500 minus 259, which is $241. So now if you want to buy a put option, let's see what would happen to your profit. So let's say you bought this 162.5 strike price for December 3rd at $4.20. So now in order to break even, you do the opposite of what you did in a call option. So basically you take the strike price, which is 162.5, and subtract the premium in order to get your break even price, which in this case would be $158.3. So if the share price of AMD were to be below $158.3 on the day of expiry, that's when your option would actually yield some profit to you. And you could apply the same principles as in the call options as to what was taught here. Other than that, there's also graphs to depict this, but I'll probably go over that in another video. But as you can see, Robinhood does a pretty good job to tell you how much percent change you need in the price in order to break even at this particular price per option. So it's all decently clear here, but some things to keep in note with respect to expiry dates of options is that the further you go out, so let's say you go, as you can see, 165 here is 2.59, but the more time to expiry you have, the more expensive your option basically becomes. And this theory should make practical sense to you, because you're giving yourself more time, or you're giving the stock price more time for it to move above its strike price. So in order to have more time for the stock price to do that, you basically have to pay a higher premium of $4.68. Another reason for this higher premium would be because this particular option is less risky, as you have more time to be within the strike price. But now, with that being said, it's also, I guess, important to keep note that this earlier expiry date option has a lower strike price but is riskier. But as with everything in life, high risk, high rewards, right? So if you see the percent change of this option today, since it has an earlier expiry date than the December 10th option, this one moved 100.78% today, while the one on December 10th only moved 67.74% today. That also means that if the share price moves significantly closer to the expiry date of the option, it means that you're going to see a greater change in the price of your option, and thus you can basically have bigger and more exponential profits. So if any of you have access to insider information and know exactly when a stock is going to pop or drop, make sure you buy the respective option with the expiry date during the same week as the stock price would pop for maximum gain. So some other factors that affect option prices are interest rates, dividend yields, and volatility. But these are a little more complicated, and again, I'll talk about this in another video. So I don't recommend you just yet to start trading options, but if you feel confident, or if you have that insider information, then by all means go ahead. I can't stop you. But that's it for today's intro to options. Hopefully you learned something new, and I'll see you guys in the next video.